Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, Money Distilled newsletter author and senior reporter.
Happy New Year, John.
Happy New Year.
Did you have a nice Christmas?
Yes, it was fine, thank you.
Did it tell you anything about the coming year?
Actually, weirdly enough, not really. This was one of those years where I didn't feel there was any real changeover. I mean, obviously it's daft, but it's a useful period of pause and reflection and all that stuff. But I feel it's just more of the same.
Yeah.
Same problems that we left behind in December are back in January, strangely enough.
Same problems, maybe different solutions.
Yes, actually, that's true.
That is true, and we will come to that. I'll tell you what I learnt during my holidays, that in future I'm going to fly on British Airways as little as possible. And I'm definitely not going to long haul on British Airways if I can avoid it. I wrote a bit before we left about luxury travel. Do you remember that?
Yes.
And about the rise of luxury travel and why it is that lower income and lower wealth people are travelling in a much more luxury way and to more interesting, bizarre places than they might have before. And we're all like, it's just the experience economy. I met someone who runs a travel company in South Africa who explained it to me.
Oh.
And he explained it like this. Social media has changed the net present value of travel.
That's really interesting, actually.
Isn't it? So when you travel now, you're not just having the experience, you're using the experience to give yourself status and conversational value years into the future.
So it's basically the attention economy.
Yes.
That's brilliant. Actually, that is really interesting.
Really interesting. So that's what I learned. And I'm going to pick that up in future because I've been talking a lot about luxury travel and why it is that this is happening. And when I was asked by one of our colleagues at the end of last year what number we should be watching to tell us what might be happening coming into this year, I said we should be watching the number of seats that are sold at full price in first class cabins, because luxury travel is an indicator of so many things that are going on around the world. And this the way this was explained to me makes it even more interesting. So we're going to watch this very carefully. What else does social media increase the net present value of?
I think that's a really interesting way to look at the world. No, we should. Yeah, they're definitely going to think more about
Absolutely. So keep that in mind. And I won't tell you who explained it to me like that because he won't want me to, but it was very interesting. He said some other interesting things too. Anyway, moving on from that, we have to talk about gilt yields, don't we?
Yeah.
And poor Liz Truss.
Yeah, we do. So we started the year and gilt yields have now, particularly long-term gilt yields, have rocketed to, rocketed is probably fair, to the point where they're now at the high, 30-year yields are the highest they've been since the late 1990s. You know, so Tony Blair was the Prime Minister at this point.
Happy days.
Happy days. No, not really. That's a joke. And 10-year. The 10-year is now sitting at like 4.8% this morning. And that's like well up from, whatever it was kind of like 6 months ago. And basically, it isn't just the UK. This is kind of a response to yields in the US going up. And actually, there was a chap on Bloomberg TV yesterday, Torsten Slok, from Apollo Advisors, Apollo Global Management. And he was saying that the US is potentially facing a Liz Truss moment because of the kind of volatility.
It's nice for Liz, actually.
It is, isn't it?
There's global recognition.
Exactly. I was just saying she's managed to supplant Lehman Brothers as the kind of go-to metaphor for carnage. We used to say a Lehman Brothers moment is coming, and now it's a Liz Truss moment. I mean, I feel that, as you say, kind of like posterity. The one problem is that if it carries on like this in the UK, she might be supplanted by Rachel Reeves quite rapidly.
A Reeves moment. A Reeves reaction.
Yes, a Reeves reaction. That'd be quite good. I like that.
Write that down.
Also, Liz was a lettuce. Rachel could be romaine or rocket. I quite like rocket.
A rocket?
Yeah, the salad. Do you know how rocket? What's it
Okay,
called?
I see what you mean. I thought we were
What's
looking
on
for something that lasted a bit longer than a lettuce, because she's been around for
I said,
longer.
that's
Rocket wouldn't last
true.
any longer than a
Ah,
lettuce. She's like more like a
schoolboy
sweet
error.
potato.
Yeah, sweet potato.
They last a long
yeah.
time in the fridge.
Yeah, I mean, the problem is it just doesn't have the alliteration, does it? Anyway, yes, that's a good point. I don't know my salad sell-by dates, which may explain
very
that bout of
non-domestic.
food poisoning
Talk to
over
Teresa
Christmas.
about this. Anyway, moving on.
Moving
on. This means quite a lot of not very good things.
It does.
I mean, the first thing we should say, actually, is that, we've been saying for a while, interest rates are not going back to where they were.
Yeah.
Prepare for higher interest rates indefinitely.
Yeah.
We're back to 4% plus. We're not going below, and you need to organise your life around that, and that has impacts for everything from your mortgage rate to your investments to the way equity markets will move, etc. But for Rachel Reeves, so I guess we might as well move straight on to calling poor Rachel, it takes away all her fiscal headroom, plus a bit, makes things look quite nasty, means there's going to be more borrowing ahead, means there's going to be more spending cuts ahead, and we will come to this in later podcasts, means, yes, you guessed it, your taxes are definitely going up a little more, or maybe a lot more.
I mean, she has kind of trapped herself, because she said that she wasn't going to break the fiscal rule and that was, a kind of red line, and she also said that she wasn't going to raise taxes, and at this point she can't do both. I mean, what probably happens is she'll end up doing neither. And we can, talk about what tax rises might be coming in spring if this is indeed the case. It is that issue of, I think the biggest risk in 2025 and generally, and it's not just the UK, is that to an extent I feel that markets have been kind of kidding themselves on a bit over the last 2 years and still not accepting that this is the new normal. And I think that 2025 is the year that we're going to see that actually embed in the consciousness. And that's the other reason why I suspect that this is the year that we'll see at minimum a 10% correction in US markets. But honestly, my gut feeling is it would probably be more like a bear market.
It's just hard to see with American valuations at this level.
Yes.
And by the way, listen to Friday's podcast on this, because I've got a great guest and we're going to talk about valuations a lot. But with valuations at this level and yields rising at this speed, it's very hard to see how the most expensive stocks in the US can carry on like this. It's very hard to see how, for example, private equity can carry on with the valuations they have at the moment, etc. There's a lot that feels like it should change as yields stick at these levels and are currently still rising, right?
Yeah, absolutely. I mean, the other interesting thing in private equity specifically is I'm kind of wondering if they will cram a pipeline of IPOs out. And actually, I suppose the other interesting thing on that front is maybe you don't care where you list it if you just want to get it off your books.
At some point, you've got to get it off. And when those things start coming to IPO, then we will find out whether the valuations at which they were on private equity books were correct or not.
That's going to be very interesting.
And then we'll find out what happens when you buy a company, jam it full of debt, rip out the dividends, and then try and flog it onto the greater full. We'll see what actually happens then. I might do too down on private equity. Maybe we'll come back to that in another podcast.
Maybe we'll come back to that bit.
But listen, John, the other thing that we've talked about over the years is how an awful lot of the things that we've seen around us, ESG, DEI, etc., are luxury goods. Luxury goods from a very low interest time. And we're beginning to see changes in that area as well. Right? There's a lot of backing off from DEI. There's a lot of backing off from ESG. And interestingly, we saw this week JP Morgan being one of the latest banks to leave the Net Zero Banking Alliance. And I remember when I wrote that book, Share Power, a couple of years ago, I listed all the organizations that the big fund management companies had signed themselves up to, hamstringing them and locking themselves in so that there were limited actions that they could take outside their membership to all these groups. And this is one of those climate groups that was on that list, and now they've basically all left it, right? Bank of America has left it, Wells Fargo, Citigroup, Goldman Sachs, they've all left this group. So there's a big rolling back from ESG. And then, of course, also of interest was Meta's move yesterday to say that they're getting rid of their politically biased, or I'm using Mark Zuckerberg's word here, politically biased fact checkers.
Yeah, I mean, I think that's really interesting because it feels like, actually, I was saying earlier that it's almost like a rollback of overly pushy compliance culture. So you've got all of these companies that have essentially voluntarily, as you say, sort of hamstrung themselves by, bringing in things like kind of apparently independent fact checkers, by signing themselves up for, again, voluntary disinvestment organisations. And now that's starting to get wound back. And I'm quite interested to see whether that actually becomes part of a bigger pushback against the box ticking culture that we've had in place I mean, actually, for even before 2008, but certainly after 2008, the compliance team became the most important person in the financial services office. And to an extent that metastasized everywhere to the point where HR was the most important function.
Yeah.
And I like to think that a higher interest rate environment is going to start
Shift that.
Exactly, make people focus on what's actually what matters.
I mean, it's interesting when I wrote in one of my newsletters before Christmas about this rollback from ESG and how even if funds aren't ESG funds these days because the ESG department has such power in so many fund management companies, everyone's an ESG fund. And so, it'll be interesting to see how that rollback happens. With that in mind, I'm talking about the end of the era of financial and social and HR luxury product. There's a report that I just got out today from BCA Research, who we both look at quite a lot, don't we? We like BCA.
Very good.
BCA. And the report is titled Climate Change and Stocks Some Like It Hot. And the basic message is that mankind today is convinced that global warming bad for economic growth, for corporate earnings and for humanity at large. And they say, well, maybe it's not a positive for humanity in the very long run, but in fact, global growth and corporate earnings will not be affected inside most investors' timelines in any way whatsoever. So the message, and BCA, do let me know if I'm misrepresenting you here, but as far as I can see, what you're saying is ignore climate change when it comes to investing and do not let climate change considerations force you to make any changes whatsoever to the weight of equities inside your strategic asset allocation, because it doesn't make any difference.
That's kind of obvious. I mean, it's not even... I don't think that should even be a controversial thing to say.
But I bet it is.
Oh, no, I'm sure it is. But I mean, the fact that they're saying it now also kind of points to what we were just talking about, the feeling able to say these things, which lots of us view as common sense, but which were somewhat stifled during a period where, to say that was deemed as akin to saying we should set all the forests on fire. There's two very different things. And the reality is that, the most people's time horizon is not going to affect it. I mean, obviously, there's the whole energy sector is a different matter because we've got policies that are actually, damaging our ability to have cheap energy. But again, hopefully that will start to get rolled back.
Yes, we're talking again on yet another day, John, where there's very little wind.
Yeah, aye.
And the risk of blackouts in the UK is higher than it normally is.
So, and I don't want to go back to the 1970s.
Oh, come on, you liked sitting around with candles, telling stories of an evening, wondering if it come back on, time to have a bath the next day.
I was only 5, I couldn't hold a candle. No, that's...
Right, I think we're going to leave that there. I'm going to write more about this in the newsletter at the end of the week. So everyone sign up for that and you can read all about it. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Sam Asadi, production support and sound design by Moses and questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.